Financial for today's presentation. And I'm going to turn things over to Gordon now to get started. Welcome, Gordon.
Thanks, Marina. And Marina, I really appreciate the opportunity you've given me to deliver this presentation to the Charity Village audience. You guys do great work to support the nonprofit and charity sector in Canada, and I'm thrilled to be working with you to help charities and nonprofit organizations understand their financial statements and reports. Now, as Marina mentioned, my name is Gordon Hawley, and I'm the President and CEO of Humanity Financial Management. As a CPA, CA for over 25 years now, I love helping individuals and organizations that are trying to make the world a better place. In my role at Humanity Financial, I see the stress and anxiety produced by finances and financial reporting for many not-for-profit organizations, charity board members, and senior staff. So we built our company to provide financial oversight to mid-size nonprofits and charities to help them better manage their internal finances and financial budgeting and reporting. Ultimately, our company works to instill confidence and credibility in organizations by streamlining their internal financial management so that they can focus their energies on their programs. Now, we chose specifically to work in the nonprofit sector, not only because we believe it has some great opportunities for improvement, but it also includes the added bonus of being filled with the people that we just love working with. You know, life is too short not to feel like you're making a meaningful contribution and working with people that you really enjoy. And we love that we can leverage our financial expertise to make a meaningful contribution to people and organizations that are trying to make the world a better place. And we find inspiration from the individuals who work tirelessly for their causes. And many people think that working with numbers is dry and boring, but I ultimately get to work with people. And I love it when I can help make their lives a little easier and a little less stressful. And working with numbers allows me to do that, and I love it. So far, I have about 35 cumulative years of board experience, mostly as treasurer, and I'm currently on the board of 3 small to mid-sized nonprofit organizations and charities. One of the boards that I'm on is Vantage Point here in Vancouver. I also facilitate most of their financial governance workshops and for not-for-profit organizations and charities. And I'm also doing financial governance webinars for, like this one for Charity Village and for the Canadian Charity Law Association. In addition to our training today, our firm offers a 2 to 3 day financial management training program called the Certified Not-for-Profit Accounting Professional Program. And this is suitable for accountants who are moving from the for-profit sector to the not-for-profit sector, as well as for board members and senior staff at not-for-profit organizations and charities. So that's enough about me. Let's dig into the content of today's session. 2 slides in and already behind. Here we go. Let's see. Get caught up on the slides. There we go. So here's the agenda for today. I'm going to spend a minute or two going through the agenda, but before I do, I want to provide you with some context. Back about 30 years ago, I spent about 6 years full-time in an accounting firm, going to accounting school in the evenings and weekends and summers, and that's what it took just to get my CPA. Following that, I've spent about the last 20 years learning more and more about reading and understanding financial statements and how to design and build effective reporting systems. And it's taken me years to develop the skills that I have today. So as we go through the next hour, please keep in mind that there's only so much we can do in an hour. Learning to read and understand financial statements will take most people significantly more than a single hour. So I just want to set your expectations. You know, it's unlikely that you'll emerge from this session and be able to interpret financial statements like a pro. But I had the choice of providing a limited amount of easy material that everybody could follow, or going for a more sophisticated approach, which would help people learn more about what some of the real issues are faced by the majority of nonprofits and charities around financial reporting. And I chose the latter, and I think it will be a more practical use of your time. But it also means that not all of the slides and the content will make immediate sense to everyone. However, I've tried to provide useful information in the slides that you can return to and some resources that you can go to learn more. It is a complex topic, so we'll cover a lot of material today, but it might be a little like drinking water from a fire hose, so be prepared. At the end of the session, you should have a list of issues that you want to learn more about, and you'll have some resources that you can use to follow up. So my overall objective is to really give you awareness of some of the things that you should be aware of when you're reading financial statements and reports from nonprofits and charities, and give you some context so you'll understand the big picture. What I hope to do, what I hope to achieve in the next hour is the following. I want to give you a quick overview of why financial governance is important, and I want to give you a sense of the financial governance roles of the board and individual directors. And I think these are useful even for staff members and other volunteers. I want to give you an introduction to Canadian financial statements for not-for-profit organizations and help you identify issues and ask good questions. So we'll talk about the roles of external auditors and how you can tell if you're required to have an audit. I want to draw your particular attention to your revenue recognition policy. Now, there's about 13 or 14 accounting standards that are different for nonprofit organizations than they are for for-profit organizations. But the choice of policy that your organization has selected around revenue recognition in particular can have a huge impact on what your financial statements look like each year. So we'll spend a bit of time on that particular accounting standard. I'll want to talk briefly about the internal use financial statements and reports and the roles of internal bookkeepers and accountants and treasurers. And then finally, I'll want to talk to you a bit about how you can improve the level of financial understanding around your board table. If your organization is unincorporated, or if you're subject to an audit or review engagement, this webinar may be a bit overkill, but there will still be lots of useful information if you want to learn about how to read and understand financial statements, but the content may not be immediately relevant to your existing organization. And note that I've erred on the side of providing too much information in the slides, and I'll be going over it very quickly, but you can always go back and review the slides at your leisure or rewatch the presentation. So I think that's enough of an introduction, so fasten your seatbelts and let's get going. Okay, so to start off, we've got 2 polls that we'll go quickly through.
Great. I've launched the first poll up on the screen, Gordon. Does your organization use an external accountant for your year-end financial statements? So go ahead and vote on your screen. And it looks like we've got most people voting. So I'm going to go ahead and close the poll now because I know we want to continue on quickly, but I'm going to share the results here. So we have 67% Gordon say an audit, 11% a review engagement, 3% a compilation engagement, 11% we don't use an external accountant, and 8% don't know.
Wonderful. That's great. Thank you.
Great.
So let's go on to poll number 2.
Excellent. So once again, feel free to vote on your screen. What is your position in your nonprofit organization? Board member, executive director or CEO, management other than ED or CEO, staff, or a non-board volunteer other. Excellent. I'm just going to share these results again. So we've got 24% board member, 22% executive director or CEO, 27% management, 22% staff, and 5% non-board or other. So we've got a pretty even split there, Gordon.
Wonderful. That's great. That gives me a good idea of who I'm talking to. So thank you for that. Okay, so first I'm going to spend a few minutes talking about the board financial governance roles and responsibilities. So if you look at an organization holistically, there are 3 primary types of activities: governance, management, and operations. And regardless of whether you have a governance board or a working board, and a working board really is an organization without staff, the board needs to ensure that it's providing at least a governance role. And the other 2 types of activities, management and operations, may be taken on by the board, but even then the board absolutely needs to make sure that it makes room for governance. That is, it's one legal responsibility to govern the organization. And the boards are ultimately responsible for the financial performance of their organizations. And these are words that we use to describe the roles of board members: stewards, fiduciaries, trustees, guardians, and you can see the definitions there. But as not-for-profit organizations and charities, we're generally provided with funding by our donors or members. They entrust us to safely steward those funds and to spend them effectively. You can see the common elements in each of these titles. And basically, board members and not-for-profits and charities are entrusted to govern their organization and its financial assets for the benefits of their stakeholders, including their members, funders, their community, the Canadian public, the Canada Revenue Agency, and possibly others. So they have 2 roles. In their first role, they're really a supporter of the CEO and staff. How can we support the organization to achieve the mission? But the second, they also play a watchdog role to make sure that the CEO and staff are doing their roles. And usually they manage the CEO and the CEO manages the staff. But there is a watchdog role for the board to make sure that, that the organization is doing the things that it needs to. And this is the governance role. Now, here's a slide that shows the primary financial governance risks that most organizations face. And we'll talk a little bit about the first one, which is occupational and employee theft, fraud, and embezzlement, just because it is so prevalent in the not-for-profit sector. If you look at the surveys, done by PricewaterhouseCoopers or the Association of Fraud Examiners in the US, or frankly, anybody that's ever done any research. The numbers may astound you. Many organizations wrestle with the possibility of running out of cash. There's often CRA payroll reassessments where organizations are reassessed because they hire people as independent contractors when they really should be employees. There's losing your charitable or nonprofit status. Losing your charitable status, in case you didn't know, results in a 100% tax of all the charity's assets. You can either give them to the CRA or you can give them to another charity. But it's obviously very intense penalty, so you got to be careful about that. And then there's the reputational risks around inappropriate asset use, ineffective asset use, and reporting errors. Okay, so just briefly, occupational theft, fraud and theft. Statistics here from the CGA Canada survey back in 2011, but these are duplicated in other surveys, about the same number. About a quarter, 26% of surveyed small to medium size organizations reported to have experienced at least one significant instance of occupational fraud in the last 12 months, in the last year. In BC, the number was 37%. And we expect the rates in the nonprofit sector to be significantly higher because A, there's generally an atmosphere of trust. B, we've got difficulty verifying certain revenue streams like cash, often weaker internal controls, in some cases a lack of business and financial expertise, and reliance on voluntary boards. So it may be that the theft and fraud in nonprofit organizations is actually as high as 40 or 50% on an annual basis. And in fact, the Canadian statistics bear that out from some PwC surveys from a few years ago. I think the numbers have gone down a little bit, but they were up at around 50% for quite a while. So what's at stake? Well, if you're running an organization as the board, there's reputational risk. There's difficulty in attracting funders and donors. If we don't manage the organization well, we may not achieve our mission, and we might possibly go bankrupt. Individual directors also have some risk. You know, they can end up on the front page of the paper. They also have some personal financial liabilities or some potential liabilities. They can be under typically under an Employment Standards Act, although the rules vary from province to province. They can be held liable for up to 6 months of wages. The CRA can come after directors personally for missed payroll remittances and missed GST, HST remittances. And directors can also be personally sued if they're didn't fill their role. So directors actually have some risks. So learning to read and understand financial statements and understand the decisions that that directors are required to make is actually really important if you want to reduce your personal risk. So this slide shows the financial roles and responsibilities of the board. I don't want to spend a lot of time on it, but suffice it to say there are some specific things that boards as a whole need to do, and here's a list of 5 of them. And here's what I think the roles of an individual director are with respect to financial governance. So the first one is read and understand all financial statements and financial reports. And if you have any questions, you got to keep asking questions until you understand the report and the relevance for your organization. In addition, you want to satisfy yourself as an individual that the strategic plan is the most effective way to achieve your mission, that the budget is the most effective way to spend the available funds, and that the organization has enough financial resources to achieve its mission, that it's financially healthy and on budget, it has enough insurance and financial reserves to protect itself, it's effectively managing its financial risks, and is on side with the Canada Revenue Agency and other regulators. And just a note, individual board members cannot abdicate or delegate these roles without taking on personal risk. So let's talk briefly about external financial statements. Now, if you've got a small organization, let's say under 50,000 in revenue, and you've got no external funders that require reporting or an audit, you know, you got a decent bookkeeper, maybe they have a certified professional bookkeeper designation, you got a strong treasurer, you got a CPA, and you're comfortable filing your payroll, sales tax, and your charity and nonprofit information returns, you probably don't need an outside accountant involved. If you do get an outside accountant involved, and there may be many reasons to do that, there are 3 possible levels of external accountant engagement. The first that you're probably familiar with is an audit, which is a positive opinion that the statement meets accounting principles. Then there's a review engagement, which gives limited assurance that the financial statements are in accordance with generally accepted accounting principles. And then the third one is a compilation engagement where there's really no assurance given. The accountant basically disclaims, they say that we haven't performed a review or an audit, we basically just compiled these financial statements given to us by management, and we express no assurance thereon. So those are the three levels of possible accountant engagement. Review engagements are a step down from a full audit, and they do not include checking with external third parties. So the accountants generally have discussions and do analysis on the numbers, but they have discussions with management to confirm, but they don't have to generally get confirmations of numbers from external third parties, which they're required to do when they're doing an audit. Compilations, as I mentioned, provide no assurance, and in fact, some CPAs do little or no work on the compilation other than formatting it in the financial statement format. So be careful. Now, some firms will do a lot more work and will help verify some of the numbers, but many don't. So be aware that getting a compilation engagement from an accountant doesn't give you much additional assurance that the numbers are accurate or complete. So are you required to have an audit? Well, the first place to look is your incorporation legislation. And we'll talk about some of those in just a minute, because the incorporation legislation often has regulations on which types or size of organization are required to have audits. There may also be requirements to have an audit in your bylaws or in your board policies. So those are two other places you should check. And then finally, funders and donors and other stakeholders like banks may require an audit, or insurance companies. So you have to look at all of those sources to determine whether or not you're required to have an audit. And just to note that the CRA does not require an organization or charity to have their financial statements audited. Just a couple of points about audited versus unaudited financial statements. Unaudited statements are usually internal, often on a cash basis, and we'll talk about cash and accrual a little further along in the presentation. Usually, unaudited statements are prepared internally or through a bookkeeper or accountant, and they're prepared frequently, monthly or quarterly, and provided to the board. Audited or reviewed, which are primarily external financial statements, are typically done on an accrual basis. They're prepared by a CPA licensed to provide auditing services or review services, typically prepared annually, and there's typically assurance provided by an external accountant. And the financial statements, both the audited and reviewed financial statements, are generally in accordance with accounting standards for not-for-profit organizations. And just to be clear, for tax purposes, not-for-profit organizations are separate and distinct from registered charities. You can only be one or the other, you can't be both. But for accounting purposes, when we talk about accounting standards and generally accepted accounting principles, not-for-profit organizations includes both registered charities and not-for-profit organizations. There's an article here by an organization called Welsh LLP that talks about the audit requirements, and I'm just basically taking the information from their website. You can see here that not-for-profit organizations and charities incorporated under the Canada Not-for-Profit Corporations Act has very specific rules about who's required to have an audit and who isn't, and I'll let you take a look at those on your own. These are the provincial requirements that are coming up for Ontario under their Ontario Not-for-Profit Corporations Act. Slightly different than the rules for the federal, but it just gives you an indication that depending on your jurisdiction of incorporation, the rules can be different. And then here's BC. In BC, we don't require anybody to have an audit under the new Societies Act that came into effect on November 28th. So you really have to look at your individual province and the incorporation legislation in your province that you were incorporated under, and any other regulatory acts that impact your organization. Here's what a typical auditor's opinion looks like. I blanked out the name of the organization, but you can see that this is an unqualified opinion. And I'll just mention that many organizations end up with qualified opinions because it's hard to give assurance with respect to cash transactions typically in many not-for-profit organizations and charities. So funders are used to seeing that. So it's if it happens, it's not a big deal for your organization typically. There's four types of audit or four versions of an audit opinion you can get. One is unqualified that we just looked at. The second is adverse, which says that the financial statements are have more than one or more material problems. There's the qualified that we just talked about, and the fourth is a disclaimer of opinion, if the auditors were unable to complete their audit. Okay, so we've talked about board financial governance, we've talked about external accountants' role in financial statements, and now we're going to dig into reading and understanding audited financial statements. So the first thing I'll point out is something that should be required reading for virtually anybody involved in a not-for-profit organization and charity is this Guide to Financial Statements for Nonprofit Organizations. Now this guide's been prepared by the CPAs of Canada, and CPA stands for Chartered Professional Accountants. In the US, it stands for Certified Public Accountants, so we use the same designation, but it stands for different things. But this guide is great because it provides a set of audited financial statements, and it goes through each of the statements and provides directors with examples of the types of questions that they should be asking. And it also talks about generally accepted accounting principles in general. It's a bit of a dry read. It was written by accountants, I'll grant you that, but it is the best resource in Canada I've ever found to help people understand how to read and understand financial statements. So I strongly recommend this. There's a link down at the bottom there, but you'd probably be better off just Google searching for it. But I highly recommend this to anybody that wants to read and understand financial statements. So if you do a Google search for reading and understanding financial statements, there'll be a lot of material that comes up, but most of the material that comes up is for-profit organizations, which have different rules than nonprofit organizations. And also most of the reference to US organizations, not necessarily the accounting rules for nonprofits and charities, because the rules are different in Canada than they are in the US. So I take my word for it, go back and find that guide that I was just mentioning. That's the best resource available, and be skeptical of other resources you find because many of them aren't Canadian and they don't apply to charities and nonprofits. So one of the first things to understand, if you're looking at a set of financial statements, you need to know whether they were prepared on a cash basis or an accrual basis. Just as an example, QuickBooks, you can run any report in QuickBooks on a cash basis or an accrual basis. And you have to know which one. And in QuickBooks, if you run a report, it actually says up in the top, I think, the right-hand corner, whether it's a cash basis or accrual basis. So make sure you look at that if you're getting reports out of QuickBooks. But for your financial statements, you'll want to know as a board member whether they're prepared on a cash basis or accrual basis. If you're having an audit done or review engagement done, the statements will be prepared on an accrual basis. And that's one of the benefits of audited or reviewed financial statements. The CRA doesn't require accrual basis for nonprofits and charities. You have the option of using the cash basis, and there might be some size restrictions on that. I can't remember. Anyway, with cash basis, financial transactions are recognized when cash changes hands. So this is really a timing issue. Revenue is recognized when cash is received. Expenses are recognized when cash is paid. There's no accounts receivable, there's no accounts payable, there's no deferred revenue. They're generally not going to be in accordance with generally accepted accounting principles, which requires an accrual basis. And for all of those reasons, the cash basis is generally not recommended. Just as an example, if you had, if the organization was running short of cash and you'd receive 10 bills for $20,000 that hadn't been paid, they would not be recorded in the financial statements if you were recording transactions on a cash basis because the bills hadn't been paid. And that could be potentially misleading to anybody reading your financial statements. Whereas if you prepare this, if you record events under the accrual basis, then financial events get recognized when they occur. Revenue is recognized when it's earned or invoiced, or following the deferral or the policies that we'll talk about in a few minutes. And expenses are recognized when goods are received or services performed. So on accrual-based financial statements, you will have accounts receivable, you will have accounts payable. For not-for-profit organizations and charities, if you're following the deferral method, you will have deferred revenue or deferred contributions. So in order to understand what you're looking at, you need to know whether they've been prepared on a cash or accrual basis. Now, here is probably the singular biggest issue to understand if you're trying to understand a set of nonprofit financial statements in Canada, because CPA Canada gives us two choices with respect to how we're going to recognize revenue, and it makes a huge difference to what your financial statements look like. The first possible method is called the deferral method, and the second is called the restricted fund method. And believe it or not, depending on which policy you choose can determine whether you show big surpluses and deficits from year to year, or whether your results are more sort of break even every year. So the choice of policy can have a significant impact on what the financial statements look like. So let's talk first about the deferral method. Now, the deferral method is the most popular method. I think I've seen some statistics that say something like 70 or 80% of the organizations in Canada follow the deferral method. So under the deferral method, surpluses on donor restricted funds are deferred to the balance sheet and recognized as revenue when expenses are incurred. Okay, so that may not make sense right away. You may have to read it a couple times, but it's a really important concept. The intention of following the deferral method is they recognize that nonprofits aren't like a for-profit organization. We're not trying to measure profit from year to year. We're trying to see how the organization spends its money. So it attempts to show nil surpluses on all donor restricted funds, and the impact is that it evens out income from year to year. And the only surpluses recognized in the statement of operations are actually on unrestricted funds, which are generally much smaller for many organizations. So let's take a look at a specific example. Let's say I receive $1 million contribution on the last day of my fiscal year, and I'm only able to spend $100,000. In this case, I would start with $1 million in the bank, but I'd spend $100,000, so that'd reduce my cash by $100,000, and that would increase my expenses by $100,000 on the statement of operations. From a revenue recognition point of view, I would recognize enough revenue to cover the expenses, which would show a nil surplus or deficit for the year with that restricted contribution, and I would be left with $900,000 as a deferred contribution on my balance sheet. So this is where deferred contributions come from on the balance sheet, and it's important to know that for all restricted funds, and these are funds with external restrictions, I'm only going to recognize enough revenue to cover the expenses that were actually incurred during the period. So following this method, many organizations will show close to zero. They'll show small surpluses and deficits from year to year on their unrestricted funds, but any of the potentially larger surpluses or deficits will generally be showing up as deferred contributions on the balance sheet. Now, this is the table that actually shows up in the accounting guidance, and I'll let you go over this when you have a moment, but it basically shows that there's 3 types of contributions that nonprofits can receive. One is an endowment, the second is a restricted contribution, and the third is an unrestricted contribution. Endowments actually don't, under the deferral method, don't even go through the statement of operations. They go directly to net assets on the balance sheet. Restricted contributions, you basically recognize enough to cover the expenses of the current period. There's a couple of other complications if you have received them in respect of a capital asset or for debt payment, but we'll ignore those for the time being. And then there's unrestricted contributions, which you recognize as revenue in the year, generally as you receive it or you become entitled to it. The restricted fund method, by contrast, generally recognizes 100% of the revenue received in the year, regardless of how much you've spent. And as a result, it often shows significant fluctuations in surpluses and deficits every year. And it's primarily used by organizations that follow fund accounting and want to show surplus and deficit by fund restriction. So, and we'll go over a couple of diagrams that'll show that better in a few minutes. Here is the diagram provided by the CPAs, again, dealing with the same 3 types of contributions, endowments. And by the way, endowments are generally where the capital contribution is restricted permanently. So if somebody gives you $1 million as a capital contribution, then the organization would be able to use the income generated by that contribution, the investment income earned on that contribution every year, but the capital contribution they wouldn't be able to spend. It would be a permanent endowment, and that's actually the definition of endowment. For restricted contributions, generally, even though there's a small complication here, for the most part, restricted contributions are you recognize enough of the contribution to cover the expenses spent in the year. Restricted contributions, this is under the restricted fund method. So under the restricted fund method, we generally recognize 100% of the restricted contribution, and unrestricted contributions, we generally also recognize 100%. Generally speaking, the restricted fund method, organizations will often show multiple columns on their financial statements because they want to show the restrictions by fund or fund type. On the deferral method, you can also show different funds, but that's not as popular. Usually on the deferral method, organizations only show one column for each year on their balance sheet or income statement. Okay, I want to talk briefly about fund accounting. I'll leave you with this slide so the information's there. But when we're using fund accounting, we break down our general ledger into multiple components. And they're typically, for example, 3 components. You might break it down by endowments, restricted contributions, and unrestricted contributions. Those might be the different funds that you set up. In which case, you might actually show 3 columns on your balance sheet and 3 columns on your statement of operations. You might have a column for endowments, a column for restricted funds, and a column for unrestricted funds in a total, and the same on your statement of operations. So that's typically the way fund accounting works. And the CPAs say if you're going to use fund accounting, well, if you're not going to use fund accounting, you should probably follow the deferral method. So they're giving some guidance to organizations in terms of how they choose their policy. If you're going to use fund accounting, think about your objective and whether you want to show in your financial statements the operations by restriction or the balance sheet items and the statement of operations, or you want to show them by activity. If you want to show them by activity, follow the deferral method. If you want to show them by restriction, use the restricted fund method. So that's the guidance provided by the CPAs, and this is actually a diagram out of their handbook. Okay, so hopefully that's not too confusing. I think it's enough to take away that you need to look, and we'll go through this when we look at the specific financial statements. You need to be aware of which revenue recognition policy you're looking at in a set of financial statements for a nonprofit organization. So the first thing I do is actually flip back in the notes to the significant accounting policies and look at which revenue recognition policy they're following. Then I go and look at the statements once I know that, because it helps me interpret the statements. So we've got, in a set of financial statements that are prepared under generally accepted accounting principles, we have 5 components. We got 4 statements and notes to financial statements. And the statements are the statement of financial position, which in a for-profit organizations are referred to as the balance sheet. We've got a statement of operations, which is often also referred to as a statement of activities or a statement of revenues and expenses, often called a profit and loss statement in a for-profit organization or an income statement. And we've got the statement of changes in net assets or fund balances. We've got a statement of cash flows and also accompanying notes to the financial statements. With respect to the statement of financial position, the organization must report on the organization as a whole, as opposed to, you can't have separate balance sheets for each separate function of an organization. And the organization on a statement of financial position or a statement of fund balances organizes accounts into asset and liability classifications such as current assets, fixed assets, current and long-term liabilities, and it's as of a moment in time. And the statement itself focuses on liquidity so that items that are more liquid are closer to the top of each section. So we'll go over that in a minute. Let's see. Okay, so here's the outline of a balance sheet. You'll see that the more current assets are at the top because they're more liquid. Current assets are typically defined as assets that will be turned into cash within a year. Then there's fixed assets under liabilities. You'll have current liabilities at the top of the section because they're going to be turned into or used to pay bills within a year. deferred contributions that we talked about, long-term liabilities, and net assets. And the assets are obviously everything that an organization owns. The liabilities are everything that an organization owes. And the net assets are essentially the difference between those two. It's sort of the accumulated net surplus since the beginning, since the organization was incorporated. So a typical statement of financial position, you'll see that it's as of a specific date, in this case, December 31, 2013. You'll notice that the balances of the assets are equal to the combination of the liabilities and the net assets. So the top section and the bottom section are equal to each other in both years. You'll also notice that the total of the assets is equal to the liabilities plus the net assets. So here are the current assets that we talked about that will be turned into cash within a year. Here are the longer term assets, so tangible capital assets, typically everything from computers, cars, buildings, and intangible assets like patents and trademarks. Then we've got current liabilities. Again, these will be spent within a year, typically. Now notice that the deferred revenue here, they intend to recognize that within the next year, so it's part of current liabilities. If it was a longer term deferred revenue, it would be down lower in the liability section. And then here's the net assets of the organization, which is, again, the difference between the assets and liabilities, or the accumulated net surpluses since the organization began. Now, we talked about the different types of net assets, that there were 3 types of net assets: endowment funds, restricted funds, and unrestricted funds. Now, when we look at the bottom third of the statement of financial position, if we're following the deferral method, we'll only see 2 classes of assets, or at most 2 classes of assets. If we received endowments, there will be some endowment funds there. And if we've received unrestricted funds that we haven't spent, it'll show up there as well. You generally won't see, in a set of financial statements prepared following the deferral method of revenue recognition, restricted funds in the net asset section, because if there were restricted fund surpluses, they would show up in deferred contributions in the liability section of the balance sheet. Okay, so that's really important. Now, endowments that we talked about, these are generally called permanently restricted. They must be kept in perpetuity by the organization, and that has to be by external donor restriction. Internally restricted funds are not supposed to be shown as endowments. And usually the earnings from the endowments can be either restricted or unrestricted as per donor instructions. Again, it depends on what the donor has indicated in their agreement. Restricted net assets include assets where the use has been restricted by the donor. Restrictions must be made by external third parties. Again, you can't have internally restricted funds as part of restricted net assets. And funds can either be restricted by activity, what you can use the funds for, or by time, when you can use the funds. Unrestricted net assets includes the cumulative net surplus or profit since the organization was incorporated. It excludes funds that have donor-imposed restrictions or external third-party imposed restrictions, but it includes internally restricted or board-designated funds. For example, funds commonly earmarked for internal restrictions such as capital or operating reserves. Just a note on operating reserves, if you don't have one, it's certainly a best practice to have one. If you can at all start generating an operating reserve, ideally, most organizations should be shooting for 3 to 6 months of expenses in their reserve. And the reserve shows up on the balance sheet as internally restricted net assets that aren't available for spending, that the organization is going to keep as kind of a cushion to protect itself in case something unforeseen happens in the future. It requires a board motion to set up, can be changed by the board at any time, and it typically shows up as a separate fund under the net assets on the statement of financial position. Now here's a statement of financial position. Just note that you generally want your deferred revenue to, you generally want your cash balance up at the top there to exceed your deferred revenue, because part of that cash is going to be cash that you've received that hasn't been spent. If your deferred revenue exceeds your cash, it means you've borrowed, the organization's borrowed from its deferred revenue to pay for other expenses, and that's not probably generally allowed by most funding agreements and certainly wouldn't be considered a best practice. I'm not going to go through this slide. Just note these are questions that are in that guide from CPA Canada, specifically with respect to the statement of financial position. So I'll let you go over those on your own. Here is the statement of changes in net assets. Now, the statement of changes in net assets starts with the balance of net assets at the end of the previous year, and this ties into the last year's ending balance on the statement of financial position. So the two statements tie in. It also ties into the current year's surplus from the statement of operations for the excess of revenues over expenditures. And generally, it also ties into the, well, it always ties into the statement of financial position for the balance at the end of the year as well. So the statement of, this statement ties in the balance of net assets on the statement of net assets with the changes or the surplus for the year from the statement of operations or the surpluses of revenues over expenditures. Here's a typical statement of operations, and note that it's for a period of time. This example, by the way, is all following the deferral method of revenue recognition. We've got a notice it's for a period of time. Here's the revenues at the top of the statements, the expenditures at the bottom of the statements, and the excess of revenues over expenditures. And just note that, again, if we're following the deferral method, the excess of revenues over expenditures for this organization are only going to be with respect to unrestricted funds. If there were restrictions on any of the contributions, any unspent funds would show up as deferred contributions on the statement of financial position, or statement of net assets, or sorry, the statement of fund balances or financial position. Here's questions from the CPA guide with respect to revenue. Here's some more questions with respect to expenses. There's a statement of cash flow. If you're just learning to read financial statements, I would probably stay away from this statement. It actually causes accountants a lot of grief around how to prepare it and interpret it. So unless you're a relatively sophisticated user, I'd probably stay away from it. There are two methods, though. I'll just let you know that there's two methods. There's an indirect method, and there's also a direct method. And I'm going to go fairly quickly here because I know we're limited for time today. And then the notes to the financial statements are worth a read. They give you a lot more information about the items on the balance sheet and the statement of operations, or the statement of fund balances and operations. And they're absolutely worth reading and understanding. So I'd encourage you to go through those fairly closely. There's a set of the start of what a set of notes to financial statements looks like. Okay, and very quickly, the restricted fund method. We've talked about what the restricted fund method is, but this just gives you a sense that generally under the restricted fund method, you'll see on the they'll break the funds down into different categories. In this case, a general fund, a capital assets fund, and an endowment fund. The statement of operations is done the same way. Usually it'll come to a total. Let's see. Yeah, and now in this case, they've actually combined the statement of operations and the changes in net assets or changes in fund balances. So you'll see the statement of operations at the top and the statement of changes in fund balances at the bottom. There's also something called functional reporting. Now in the States, this is required. In Canada, you're not required to, yet in the Canadian standards, you're not required to publish functional reporting, which is basically allocating expenses to different programs. We are required to do it on a summary level for the T3010, which is the information return that all charities are required to provide to the CRA. We're required to break down all of our expenses between program services, management in general, and fundraising, but we're not required to do it for financial statements. But if you were going to do it, it's certainly optional. You can do one if you want, and you can either prepare your statement of operations like that or have it in the notes to the financial statements. And this is kind of what it would look like. So here's, and there's many different ways you can do it, but here would be a typical schedule of functional expenses broken down into Program A, Program B, Program C, and then supporting services broken down into management, general, and fundraising expenses. With respect to internal statements and reports, just to note, there are different roles in organizations, and I'm going to say virtually all not-for-profit organizations, regardless of their size, should be fulfilling all three of these roles. There should be somebody doing the bookkeeping tasks, somebody doing the controller tasks, and somebody doing sort of a part-time CFO or VP finance role. And this controller and VP finance or controller and CFO roles would generally be done by a CPA, and the bookkeeper likely doesn't have a CPA. But even if you're a very small organization, having a part-time controller review the work of your bookkeeper and making sure the numbers are accurate and complete is absolutely critical from my perspective. So those slides just give you some more information. We do have a table here that talks about the board roles and responsibilities, treasurer's roles and responsibilities, as well as what often treasurers are asked to do, but probably shouldn't be required to do. Because if you ask your treasurer to fulfill these controllership roles and CFO roles, and in some cases the bookkeeping role, you'll likely burn through treasurers fairly quickly. So I'll leave you to read through the treasurer's primary roles. Now, if you're putting together a board reporting package, here's sort of a typical package that we'd see: a comparative statement of financial position and a budget compared to actual with either month-to-date, year-to-date, or annual results, and some summary and analysis of the financial results. So typically significant variances with explanations for the variances, and then a listing of any issues for discussion by the board, issues for decision by the board, and possibly a resolution or two to approve changes to the budget. Here's what a typical variance analysis would look like, and you'd pick out your significant variances and do some variance analysis for the board. For the finance committee, we'd recommend a reporting package that includes everything that you would give to the board, plus some significantly more detailed organization. So the finance committee would generally review things on a fairly detailed level, whereas with the board, we try and provide mostly all the reports on a very summary basis. Here's some great resources for key performance indicators or KPIs and dashboards. So the nonprofit financial stability KPI recommendations and a nonprofit financial health analysis worksheet. Worth having a look at those to see if you want to pull any of those out and use them for tracking and reporting KPIs for your board. In addition to the monthly reports we talked about, boards will also get periodically copies of the budget to approve. They'll typically get a cash flow projection. Cash flow projection is so important because it will foretell you if there's going to be any cash flow issues during the year. And then you, as an organization, you may also want to get on a regular basis an accounts receivable aging detail, an accounts payable aging detail, and possibly payroll expenses by position so that you have a sense of what's being paid there for your payroll. Often for most not-for-profits and charities, payroll is one of the biggest items on their statement of operations. Okay, so in many organizations, boards have at best a root entry understanding of financial information because many people, let's face it, don't have financial backgrounds, and they don't often get a lot of training or education around financial matters. So I really wanted to give you a sense of some of the things that you can do to encourage board members to get more up to speed and to develop their financial skills. And the first is to strongly encourage board members, particularly new board members, who have questions to get answers prior to the board meeting. So if you send them out financial reports, get them to have a read through them, come up with any questions they have. You know, there's no stupid questions, and go back and talk to either the treasurer or the CEO or whoever prepared the reports, and ask them all your questions. The more you do that, the more practice you get, the more you'll start to understand the financial statements. And again, board members should really keep asking questions until they thoroughly understand every financial report and the relevance of the financial information they're getting. If they're ever sued or if anything ever happened in the organization, you know, if the judge is, you know, he's got you on the stand and he says, so I understand you received these reports, and you say yes, and you say, well, did you understand the reports? And you go, no. It's not going to look very good to protect you from personal risk. So you want to make sure that if you're a board member, you're asking questions until you understand the information that you're getting. It's also really important to have the right team in place, so we make sure that your financial reports are accurate and complete. Again, I think most organizations should be hiring a part-time controller or CFO. And it could be a couple hours a month. It doesn't have to be a lot, but somebody really just to keep an eye on what your bookkeeper is preparing. And keep your board reports at the highest summary level that you can so that the board doesn't focus on how many paper clips you bought, so that they're focusing on strategic issues around the board table. Use dashboards where you can. Visual representations are easier to understand. And bring on new board members with a financial background. If you've got, you know, a couple of accountants on your board, a couple of CPAs, they can really help a lot with helping the rest of the board members understand the information. And then most boards should ideally providing access to training resources and actual training if required. If you don't think your board has all the information they need, it's worthwhile to get them some training and get them some information so that they can actually really understand. I mean, even giving them a link to this video might be a good start. So there are some Canadian resources I just want to point out to you before we wrap up the presentation and allow for some questions. The first one is there's a program out called Color Accounting. When I went through my accounting training, everything was in terms of debits and credits, and people generally find debits and credits really hard to understand. So a group has reframed accounting training essentially without using debits and credits. And they break down the financial statements into different parts, and then they use different colors, and so it's called color accounting. But it's a much more understandable approach to understanding financial statements. As I say, I took years of courses, and they've tried to break that down into, I think, about 5 hours of training to try and get people up to a relatively sophisticated understanding of financial statements and how they're interrelated. So this color accounting, if you're interested in kind of going to the 2 stages. First of all, read that guide from the CPAs that I pointed out early in the slides, the guide to nonprofit financial statements. That's your first step. If you still want to learn more, take a look at this color accounting. It takes, I think, somewhere between 5 and 10 hours, depending on which one you take. And it really gives a really good understanding of financial information without having to take all the courses that I took. This is, so here's a 5-hour run. You download a piece of software onto your local computer, and you go through, I think there's about 20 different sections. And I think the total cost is $100, and you can see the free first lesson up there on YouTube. So this is a great resource for people who want to develop a more thorough understanding of the financial statements that they're receiving. There are a couple of specific Canadian resources. One's produced by the Mootart Foundation out of Alberta on financial responsibilities for nonprofit boards. There's one out of the US, which is it's in the US, so there's some differences between that and Canadian reporting, but it does talk really well about assessing nonprofit financial performance. So that's a good resource for that. There's a wonderful website called strongnonprofits.org. It was paid for by the Wallace Foundation. They hired an organization similar to ours, only larger in the US, called FMA and their Fiscal Management Associates. And they developed a really strong body of information that help board members and staff understand their financial reporting and make their financial reporting stronger. So if you're looking for really good resources, and the differences, there's very few differences here between the US and Canada, so virtually everything that's available on their website is relevant to Canadian firms as well. We also have a few resources available on our website. We've got a financial management roles and responsibilities guide. We've got a basic internal controls for small to mid-sized nonprofit organizations, a treasurer position description template for nonprofits and charities, and a treasurer's roles and responsibility template that are all available for free download. And that, Marina, is the presentation I have for today. So hopefully that information was useful. I realized that it was a whole lot of information in a very brief time period, but I hope that the resources that I provided will give people some additional places to go and look if they want to learn more about reading and understanding nonprofit financial statements.
Wonderful, Gordon. Well, I know everyone really appreciates having all of those extra resources as well. And just as a reminder to all of our participants, we are going to send out that slide deck in PDF form tomorrow. So I know there was a lot of information on there, but you'll get a chance to review the financial statements and click through to all of those different resources that you're interested in when we send that tomorrow. So let's get off on a few Q&A questions here. We don't have too much time, but we'll jump right in. Let's start with, can you talk a little, Gordon, about unaudited statements at board meetings? Should those be accepted or tabled, or do you have other thoughts on that?
Oh yeah, absolutely. So generally speaking, audited financial statements or reviewed financial financial statements that were subject to review engagement are generally only prepared once a year, and they're primarily for external audiences. The reports that boards generally get, if they meet on a monthly basis or a quarterly basis throughout the year, are generally not audited or reviewed. And they're generally, in fact, the external auditor, the external accountant isn't usually involved in the preparation of those statements. Usually the statements are prepared by a bookkeeper, and in an ideal world are reviewed by a part-time controller or CFO, which is typically a CPA. So in many organizations, they don't have that role today. They don't have the part-time controller or CPA, and so the statements go from the bookkeeper to the board. The challenge is there's no regulations around bookkeepers and what it takes to become a bookkeeper. The sector isn't regulated, and so there are excellent bookkeepers out there, but there's also some bookkeepers that aren't excellent, and I've seen statements go to boards that have errors of over $500,000 that the board members didn't know about because the statements weren't reviewed before they went to the board. So certainly it's absolutely great for the board to get reports that haven't been audited or reviewed, but I'd encourage organizations to think about getting a part-time accountant to at least review the reports coming from the bookkeeper to make sure they're accurate and complete before they go to the board. Also, if you can't do that, at least try and find a CPA to be your treasurer so that your treasurer is at least reviewing the reports before they go to the board.
Excellent, thanks, Gordon. Now we have a question from Lori. You recommended a reserve fund, ideally equal to 6 to 8 months of expenses. Are there restrictions on the use of this fund? For example, could it be used for salaries?
Yeah, so what we recommend is that, and in the slide we said 3 to 6 months is sort of an industry rule of thumb. For some organizations, it may be a year if you've got a highly risky revenue streams, or in other organizations, it may only be a couple of months. And generally speaking, these are accumulated surpluses, so they show up on the statement of financial position, and they're generally not included in the budget. So generally speaking, those funds are held by the organization until, and they're typically internally restricted. So the board passes a motion that says we're going to internally restrict these funds so that basically nobody's allowed to spend them until we internally unrestrict them. And so in a typical situation, the board, let's say they restrict $100,000. So this $100,000 will show up on this in the statement of financial position, and then partway through the year, one of the major funding sources dries up. So the board will then pass another motion to say, okay, we're now going to unrestrict $50,000 of that amount that we'd previously restricted for the specific purpose of whether it's payroll or general expenses or to buy some computers or to put a new roof on the building or whatever they want, but it's entirely at the board's discretion. So this isn't money that the CEO or the staff would have discretion to spend on their own. It wouldn't normally be included in the budget, but it is available there as a cushion in case one of the major revenue sources dries up or some other calamity hits the organization, something unforeseen, that it needs these additional funds. So the board initially passes a motion to restrict the funds so that they can't be spent, and then can pass another motion at any time to unrestrict some or all of those funds to be used for whatever purpose the board deems necessary.
Thanks, Gordon. And just before we continue on, I do want to note that we are on the hour and we are very aware of everyone's time. So if you do need to leave before we wrap up the Q&A in another 5 minutes or so, just a reminder, you'll get the recording tomorrow that will include the Q&A. So you can always just skip ahead and watch the last few minutes there if you need to leave. Gordon, could you please repeat the CRA audit requirements?
The CRA does not require financial statements to be audited, period. They will, in fact, they don't require review engagement. They don't require an audit. They don't require any external accountant involvement. But just because the CRA doesn't require it doesn't mean that your organization shouldn't have an audit or a review engagement. Those are often dictated by either the legislation you're incorporated under or other legislation in your province or jurisdiction of incorporation. They can be required by your bylaws or by your board policies, and they can also be required by your funders or external third parties like banks or insurance companies. So the CRA does not require financial statements to be audited, but you may be required to have an audit for other reasons.
Great. And now you mentioned that functional accounting is not necessary with the CRA yet. Do you see a change coming with that?
The CRA does require us to break down, if you're a registered charity, they require you to break down your expenditures by three categories. You're required to break them into program spending, fundraising, and management and general expenses. But they don't require your financial statements to look a particular way or to be broken out by program or to be broken out by fund. In Canada, the CPAs, or the Chartered Professional Accountants, who generally set generally accepted accounting principles, do not require you today to do functional reporting. In the US, organizations are required to do functional reporting in addition to their typical statement of operations, which shows spending by object, like in groups like salary and rent and amortization, bank charges, things like that. So in addition to that, in the US, they're also required to have a statement or a schedule that shows all of the expenses by program. Whereas in Canada, we're not required to do that yet, but it is optional. If you want to do it in Canada, you're welcome to, but you're not required to.
Great. And is there a source for financial policy examples that are related to this topic? Is there one in particular that you recommend?
You know what? That's a great question, Marina. I mean, ultimately, what should happen is organizations should take a look at the particular financial risks that they face and then develop financial policies to address those risks. It's highly risky to take financial governance policies that were designed to address risks in another organization that may be significantly different and to apply them to your organization. So you usually want to do a bit of a risk management or risk identification and management process, figure out what your primary financial risks are, and then develop financial policies and internal controls to mitigate or reduce those risks. Having said that, there are some, I'll call them template financial policies that are available. If I've searched numerous times on Google to see if I could find some, and what you find is that there are examples from universities, because they often publish theirs. So if you're a university, you can probably find out what your competitors are doing. But aside from universities and large organizations, most organizations don't publish their financial policies. But I do have something, and Marina, I can send you over a couple of slides that list a few examples. There's one from an organization in the US called Blue Avocado, and a couple of paid services. So if you want, I can send you a list of 2 or 3 examples or templates, some of them free, some of them at a cost. And if you like, you can send those out with the slides.
Great, that would be wonderful, Gordon. I'm sure everyone would really appreciate that. So I think we're going to just finish things off there because we are 5 minutes over time. So I want to thank you, Gordon. This was a fantastic presentation. It's always a pleasure having you here to present for us. You provide so much info in your presentation. I know we've had quite a few comments already thanking you for being here today. So thank you.
Wonderful, Marina. Thank you very much. Always a pleasure. Happy to help.
And just before we sign off, I want to remind everyone we are going to follow up with you by email tomorrow with the webinar recording. We'll also have a link to a short survey. Please do take a moment to fill that out. It's helpful for us to refine our webinar content and delivery. You'll have an opportunity there to let us know if there's other topics you'd like to see covered in a future session. And if there's other financial topics you'd like to see covered, please pop that into that section of the survey. Our final webinar in this series for executives is coming up April 19th. We're welcoming back Mark Bloomberg to discuss common CRA compliance issues for Canadian charities. So we'll have registration information for that in the email tomorrow as well, in case you're interested in joining us for that webinar. With that, I want to thank you all again for joining us, and I hope you all have a wonderful rest of your day. Bye-bye.